Qualitative methods of credit control. So in this session, we will go through the introduction of qualitative methods of credit control, where we'll see effectiveness of monetary control and methods of credit control, and where there are two methods, one is quantitative and qualitative. In this session, we will only take qualitative. So first we'll see what is the effectiveness of monetary control. The Reserve Bank of India is always faced with the dual problems of ensuring price stability in the event of a steep increase in money supply arising out of a sudden expansion of credit, as well as making provisions for financing economic growth. So this is where the effectiveness of monetary policy comes into picture. So the effectiveness of monetary policy then is questioned actually due to increased public expenditure and the subsequent rise in bank deposits. Hence, the Reserve Bank is forced to adopt a balancing approach, taking shelter in a policy of controlled expansion of credit, meeting the objectives of ensuring price stability, as well as making provisions for credit for the attainment of faster economic growth. So in this context, we will see that there are two methods of credit control. One is quantitative and one is qualitative. So we will see only qualitative in this session. So next is qualitative methods of credit control. Here, what we do is we will take a look at what is consumer credit regulation very briefly. We'll also see what is margin requirements. We'll see what is credit rationing, and we'll see direct action. So first, we'll take a look at consumer credit regulation. So this is for issuing of rules regarding maintaining maturity of installment credit and down payment for goods and for purchase of goods. Down payment is normally increased or decreased based on inflation or depression in the economy. So that is consumer credit regulation. Now this is obviously done by the RBI. Next is margin requirements. This is the difference between amount borrowed by the banks and securities offered to the banks. So while granting of a loan by the bank, it is RBI's prescription to the bank to maintain a certain percentage of the margin. So during inflation, RBI will increase the margin so that only less money will be there with the borrower, and this may affect the borrowing capacity and demand for goods. Margin will be reduced in the case of depression. So these are the margin requirements, which is again a qualitative method of credit control. Next is credit rationing. What is credit rationing? So in credit rationing, RBI controls the credit granted or allocated by the commercial banks. So the distribution of credit will be done according to national economy's conditions. More demand in one sector will fix a percentage of loans in relation to total advances. And finally, we will see what is direct action. So direct action is to the banks who do not fulfill requirements and conditions. This action will be taken by the RBI. So what does RBI do to such banks? RBI may give excess credits or charge a penal rate of interest above the bank rate, or may even refuse to rediscount papers if the credit demanded is beyond a certain limit. So this sums up qualitative methods of credit control. Thank you.